have this as podcast on all your favorite platforms under that Lead Lag Live brand name, Spotify, Apple, so on and so forth. Please do me a favor if you can, because I spend quite a bit of time and effort doing these conversations. At least rate, hopefully honestly, with 5 stars, Lead Lag Live on those various platforms. People seem to be of the impression that I'm making some kind of killing with the sheer amount of content that I put out there. I can tell you that is unequivocally factually not true. So my business is my funds, to be very clear. With all that said, my name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is the man known as Brandon, Green Candle Investments. He runs a number of great spaces himself. But I don't know very much about Brandon other than the fact that he likes candles. So with that said, Brandon, introduce yourself. Who are you? How'd you get interested, involved in markets? Why crypto/Bitcoin? I know there's a distinction between the two in particular. And then we'll get to the meat of the conversation here.
Yeah, for sure. So thanks for having me on. Yeah, so as you alluded to, I host a few different spaces, one on Tuesday night that's generally around macro and real estate and stocks and sometimes like oil and other commodity markets. And then I host another one on Fridays at 4:30 p.m. Eastern time that's strictly on Bitcoin and everything that's going on in that world. But yeah, and I have a couple podcasts and other things like that too. So I'm sure we'll get into that a little bit later. But a little bit of my background, I'm an engineer and data analyst by trade. I just kind of started to get involved into financial markets when I was in graduate school, just trying to figure out a little bit about, how I'm going to actually start to use my money when I start to make it. And then just started kind of self-educating myself and listening to podcasts and various people, and then various platforms like Twitter Spaces and other things like that started to open up. So I just kind of started those open discussions that way. And yeah, so I just kind of started to get interested in everything that was evolved around money. So that rabbit hole kind of led me into various stock market investing. I have a real estate property as well. And then, of course, it led me into Bitcoin too. And I like how you already said Bitcoin and not crypto, and that there's that clear distinction. I know you had Greg Foss on a little bit earlier, so I listened to that space and it was great. So if, I definitely recommend people going back to listening to that one. But yeah, so I got down that rabbit hole. I kind of learned on everything that's kind of going on in the money, with the Federal Reserve. And that just kind of sent me down this whole, learning about macroeconomics and a lot of things that I didn't necessarily get in schooling. And yeah, just kind of trying to navigate these treacherous waters here as we have a lot going on, to say the least. So yeah, a little bit about my background, and then yeah, like you said, Spaces host, and then Macro Insights podcast, where I talk to a lot of great guests about various topics, whether it's CFAs, real estate investors, that kind of stuff. So I have a unique perspective on, I guess, all the different kinds of markets and how everything is kind of touched on the macro level. And then, yeah, I have another podcast called The State of Bitcoin, where I talk to a lot of people developing and a lot of cool stuff going on in the Bitcoin space. So I touch a lot of various different things, but all kind of revolving around the financial markets. And that's, one thing that has kind of come to interest me.
You talked about during the self-education process that you were listening to other podcasts, which, is something that a lot of people do. I wonder, though, if you think that when somebody's first learning about how to invest, that they probably shouldn't be listening to others. And the reason I say that is, with all the scandals that have gone on this year, the SEC finally getting, this guy, Zach Morris or whatever it was on Twitter, that guy and his colleagues were interviewed on a number of podcasts, and those that were interviewing him and them clearly were not aware of the kind of fraud that they were doing to their own followers. Talk about, from a self-education perspective, how do you try to avoid the wrong types of miseducation?
Yeah, that's a great point. So when I was kind of going through my self-education process, it was around the 2016-17 area time. So there was a lot less podcasts and a lot less, I guess, financial Twitter, Bitcoin Twitter, all those kind of things. I feel like I've kind of blown up the past couple years with COVID and everything like that. But I think the biggest thing that I say to people when they're kind of self-educating is, go through multiple different sources. Don't listen to one specific person, because, you could definitely get caught into a lot of those, crypto or other kind of schemes, little pump and dumps. And generally speaking, when things are too good to be true, they are too good to be true, unfortunately, because there is a lot of fraud and a lot of scams kind of going on these days, and it does worry me too because I feel like in this COVID time in the past couple of years, there's been a lot of people that have gotten interested, whether it's cryptocurrency, whether it's investing in the stock market or other things. And essentially, for a little bit of time there, you could essentially just throw money at anything and it was going to go up. But now, obviously, we're seeing some pain in the markets and other things like that. So I hope that a lot of these fraudulent schemes and other things don't scare people away, but they just keep using this time to kind of keep educating, read books. There's a lot of influencers that'll reference you to a lot of these old books that, a lot of the principles just go back and they're talking about, things like Rich Dad, Poor Dad, value investing principles that Ben Graham teaches, and everything from Warren Buffett and things like that. Just learning, going back to the basics, and then kind of, educating yourself a little bit further from there, and making sure you get it from multiple sources and don't just kind of latch onto one, maybe influencer's opinion. Because, yeah, like you said, there is a lot of fraud, unfortunately, going on right now, and it's not just in the crypto market. It's kind of prevalent everywhere. Although we do have this big FTX scandal going on, there is that one seems to get a little bit more headlines, probably just because of the sheer dollar amount that's going on in that. But yeah, I would say just find multiple people, find people like yourself and other people that are kind of in the business and have been doing it for a while. And yeah, don't really and question everything that you hear. If you're listening to something, like I said, and it sounds too good to be true, it most likely is. So
Yeah, I mean, what I'm blown away by, honestly, is that I saw this clip of it was either Zach Morris or one of his guys, where in the clip he was basically saying that he didn't have a single down day since like April of 2020. It was some kind of outlandish claim, and the host didn't even push back. It was like, "Oh, how'd you do it?" And meanwhile, it's like the moment I heard that, I'm like, "That's obviously complete bullshit." I mean, anybody that's spent any time investing or in markets should know that that's literally an impossibility. Some of these scams seem really, really obvious. Like, it doesn't necessarily require a lot of investigation or thinking, yet people seemingly still fall for them. I'm just curious your thoughts. I mean, I think you're younger than I am. Why is it that things that look pretty clear are not easily seen, or causing people to be skeptical? Because again, I just can't quite understand and get my mind around why some of these scams last as long as they did.
well, I think we're in a time now where the age of influence is, drastic and wide reaching, and that doesn't really cost too much. But in the case of like FTX, for example, right? I mean, if you really peel back the curtain and kind of look at, what all was going on behind the scenes, I guess, and with the FTX token and all that kind of fraudulent activity that was going on with that, to the average person, they don't really do too much investigation with that, but they see things like FTX sponsoring the Miami Heat arena and the NBA, FTX, their logo kind of everywhere, Tom Brady even getting behind it. So I think the massive amount of marketing dollars and just kind of, maybe unfortunately kind of pure ignorance of people just kind of first getting into the investing world and not really seeing too many of these scams, right? I mean, I think a lot of these people that are falling for it, this is kind of their first go around. They're maybe graduated college sometime in the past decade or so, and they didn't really have to invest in any other market where they saw drastic downturns or other fraudulent activity. And they kind of just believe the notion like, hey, this is something that'll make me generational wealth, or they fall into these buzzwords and these traps of, hey, I need to make a lot more money because I need to be able to retire one day, and all these other things. So they just kind of fall for that trap. And I think there's another sort of underlying issue in all of this is that at the end of the day, a lot of people need to work a 9 to 5 job that's not necessarily in the financial world, but they do that and then they come home, or they do this on the side where they have to figure out how to invest. They have to figure out how to kind of save their money and do other things, because just putting it in a savings account, even if it's high yield, I mean, maybe the rates now are at 2% or something like that, but you see the CPI numbers at a 7 plus in the past few months. You're just thinking you're losing money having that money sitting in a savings account. And so, as people kind of learn that, they're just kind of learning on the go and scrambling and not really doing too much research on it, I feel. And unfortunately, that has led to a lot of people just kind of finding stuff that sounds too good to be true because they just believe that they need to invest their money to make a living and do all these things. So, the risk tolerance of a lot of the young investors has become super high. And because it's become super high, I think they've kind of fallen for some of these traps and some of these scams. And I think that's simply a lot because of education and, just the fact that they need to invest their money on the side while also working a 9 to 5 job, maybe, having a social life and doing some other things too. So they're not giving it their full attention.
How much does age factor into this? I mean, I got to assume it's a lot of the people that unfortunately were kind of prey to these scams were probably on the younger side, but maybe I'm wrong.
Yeah, I mean, I think age definitely plays a little bit of a factor because I would say, the older generations are probably a little bit more wary. And I think a lot of these newer scams kind of came along in the tech boom that we've had going on. And the younger generation, some of them probably want to believe that they understand technology maybe a little bit better than they do. But I think that's kind of it as well, is that, it's a lot of just nuance and a lot of new um technology that's popping up. The blockchain was kind of a big buzzword, Web3, like all these kind of buzzwords had a lot of venture capital money thrown behind it. And a lot of these, people didn't really question, I guess, the products or some of these other things that were going on, and they kind of just jumped on board. So you see a lot of wealthy people just throwing money at some of these projects, FTX just tossing marketing dollars all the way around, and nobody really questioning where that money's coming from, just assuming that it's a big booming industry and they're raising a lot of funds. So I think it could be that, and definitely I think just age plays somewhat of a factor because the risk tolerance of younger individuals is probably a little bit higher than older, and they believe that they understand technology a little bit better. And I think the older generation's a little bit more wary when it comes to some of these new technologies and new trends.
Yeah, and it's also interesting that it became almost sort of a almost like a generational warfare online, right? I mean, okay, boomer and all this kind of stuff would be, kind of the retort by anybody that tried to just criticize even a little bit or poke holes a little bit at certain of these what are now clear with hindsight scams. Do you think that I hate to say it this way because it sounds bad, but I don't know any other way to say it. Do you think that people have learned their lesson after all this, or do you suspect that there's still more pain that needs to be felt to get people to be almost permanently skeptical of anything they invest in?
Yeah, I mean, I would say I'm a Bitcoin maximalist, so I've never really believed in any kind of alternative currency or cryptocurrency or shitcoin or whatever you want to call them on this. But I think that there's still the barrier to entry in a lot of these projects is so low. Like, right, you just need to kind of be able to code and you can create your own token. I think that there's always going to be some room for somebody to make some of these tokens. I don't think that there's the end of the alternative cryptos and some of these scams. I'm sure we'll see some more in the future, whether it comes out, in the next couple of years or whatnot. But I think people are going to be a little bit more wary with this one and a little bit more wary with everything in the future. But I definitely think that there's still some pain to be felt with this market. And I don't think it's really over. I mean, I think we're seeing like a lot of these crypto companies kind of hurt. I mean, we're seeing Binance, some issues are kind of going on with that company as well. A lot of these exchanges that have not really had to go through any kind of regulation or anything like that don't really have to have any of these so-called reserves or anything like that. So when these customers are just kind of making a bum rush, pulling their crypto and whatnot off these exchanges, a lot of these companies are just losing billions within a matter of days. And I think at the end of the day, a lot of these companies, no matter what, if that happened to an Apple or something else, that company would probably not be doing well as it is. But I think it's just such a young industry, and people are always going to try to find the next, I don't know, crypto or whatever that runs up. And I think that's people are still going to be looking for that thrill, whether it's a GME kind of situation in the stock market where they're buying into some failing company that thinks it's going to run up, or it's some sort of alternative crypto. I think there's been a lot of pain in this market. A lot of people have lost a lot of money on all these exchanges that halted withdrawals, but I don't think it's over just yet. Unfortunately, I think that there's still going to have to be some blood in the market. I think people are still kind of playing with fire a little bit, leaving crypto and Bitcoin on exchanges. I think that a lot of it's coming off and other things like that. But, I still think that there's room to have a little bit more blood in the market, unfortunately.
So this may sound like an odd question, but do you think that if there was maybe a better collective sense of whether somebody's full of shit or not, that we would be in this place? And what I mean by that is, I always feel like because of everything being digital and people not socializing in person as much as they socialize online, that we've forgotten what it's like to be a good judge of character. When I see these clips of SBF and other people that obviously are now getting into trouble, just it does, even the way they speak, the way their demeanor, it doesn't pass the sniff test. And I myself am a very hard worker, an entrepreneur, and I try my best to approach things with integrity in a very open way. But it doesn't seem to me like it's that hard to see that some of these people are just completely full of shit. Is it just that people have lost their sense of how to properly judge somebody else because it's all online? And maybe if more of these things were in person or visible, that there would be more skepticism. Help me understand that, because it just doesn't make sense to me that people couldn't see this.
Yeah, no, I mean, I agree with you 100%. I think, one of the biggest things is if you see an exchange or somebody else kind of creating a token and there's really no value behind it, that should be the first major red flag of anything. But, I think SBF is definitely a big cog or big person to blame, but I think a lot of it too, a big problem with it was a lot of the venture capital money that was poured into FTX. I mean, it was funded out the wazoo in order to get all these marketing dollars and get all these people kind of on board. And I think in reality, it was a lot of just ignorance into what was going on. And it was a lot of people just seeing the run up, hearing, whether it was Bitcoin, Ethereum, or one of these other things kind of shoot off to the moon. And, a lot of people were making a lot of money. So a lot of people were just FOMO and jumping in. And I think a big issue with that initially too was money was very cheap. You could borrow money for during those periods of time for basically like 0%, 0 cents on the dollar. And over time you would think that this company would just shoot up in valuation and you'd make a lot of money. So I think like if it wasn't for some of the marketing dollars and just kind of some of the ignorance and some of that, people kind of had the allure of the nerd super coder and whatnot, behind the screen, kind of creating some of these things and running such a big company of things that they really didn't understand. And I think that's the biggest thing that people need to kind of take away from all this is like, hey, if you don't really understand something that you're investing in, putting your money in, maybe just put a little bit in it if you need to, obviously not financial advice or anything. If you need to put some skin in the game in order to actually get yourself to learn it. But I think at the end of the day, now's the time where you really need to take a step back and just understand what you're investing in, how you're investing in it, like the regulations behind everything. Because as some of these things come on, it's a time where we really, that the Bitcoin Max he's saying is don't trust, verify. I think it's a big saying that's going to be holding true not only now but in the next couple years as these industries investing, all these other companies kind of start to come out of what is going on right now. And I couldn't agree more with what you're saying is you see Sam Bankman-Fried get on these interviews, his leg is bouncing back and forth and he just kind of rubs you the wrong way and it doesn't really make sense. But I think what happens is somebody like that talks really fast and he's kind of what's in right now, right? He doesn't really dress all proper, and he's got his uncombed hair and all that kind of stuff. And he's just kind of this nerdy guy who seems to know what he's talking about when it comes to cryptocurrency. But when you break it all down, he really is just talking about a scam. And I think that's what kind of happens is just people just were too trusting because everybody was making so much money during, that COVID time. And I think it was just a lot of leftover money from what was going on there. And the yield was kind of coming in and everything was working fine when the bull market was coming. But nobody was really expecting a giant crash like we got right now to affect all these companies as drastically as they have.
Do you think there was an element of relatability when it came to SBF? I mean, you kind of allude to it, right? He's kind of this nerdy guy. He talks fast. He's kind of this, coder in the background. I mean, I can imagine a lot of people in the space who, like a lot of people in general are introverts, right? Probably see somebody like that and they feel almost like a kindred spirit with that kind of personality.
Yeah, I mean, I would say like it's definitely something that he's relatable, and I think the other thing is too is like he was just everywhere, right? I mean, if you see his face, you walk around. I think I was in New York City maybe a month or two ago, maybe late October or so, and at that time they shut off withdrawals and were already filing for bankruptcy. But his face was all over billboards and all over bus stops and bus stations and things like that too. So I think it's not only like the relatability of him, but also he was just he was just everywhere, and the amount of exposure that a lot of these projects and other things get. And I heard you mention it too, that the bots were just kind of everywhere on Twitter too, bringing up all these various crypto projects. I think that the more times you just see some of these projects, see FTX, see this guy's face, Sam Bankman-Fried, whether it's in an interview on TV, billboard, what have you, so eventually you're just gonna look into it. People are curious by nature, so I think it was just a bunch of people at the end, just kind of just wanting to find the next thing to get rich, finding something that's saying, hey, like my bank isn't really doing it for me. The money that's sitting there is basically losing purchasing power as it's sitting there, not really making anything. Like I need to figure out how to make all this money. And they don't really question something that seems too good to be true. And they just go in and, they just kind of blindly put their money in and they figure out some of these projects, but don't really question it. They think that it sounds cool or, putting X, Y, and Z on a blockchain sounds cool and innovative, but they don't really question or understand the back or what a blockchain even is, or, why you need to put X, Y, and Z on a blockchain, or some of these other projects and other things like that too. So I think as we kind of get forward, a lot of these companies are going to require a lot more regulation, and there's going to be a lot more people kind of tentative to get into whether it's crypto or Bitcoin. And I hope everybody here just kind of leans towards Bitcoin and gets it off exchanges as they're seeing all these exchanges kind of go by the wayside. But yeah, I mean, I think his relatability definitely had something to do with it.
Before I bring in some of the audience, you said this point that people need to understand what it is exactly they're investing in. I know you describe yourself as a maximalist. Do you think that people, when they invest in Bitcoin, really get it, or is it the same issue that we see time and time again in any and every investment? People think they understand it only when it's going up, but they don't really understand it when it's going down.
Yeah, I mean, this is a great question. I think that there's people that have Bitcoin that don't really understand it. I think that there is definitely is people that do deeply understand it, and I think that there's a lot of people that kind of go around and talk about the theoretical stuff about it, but don't really know the nuances. I mean, there's a lot of different aspects about this. Whether it's mining, running your own node, just straight up the blockchain and other things like that. That I think that there's a lot of aspects about it that a lot of Bitcoiners maybe don't go through their 10,000 hours initially. And I think that there's a decent amount of learning curve that goes into it. So I think, the way I got into it was I put money into Bitcoin initially, and then I kind of started to learn about it. So I can only imagine that's how most people kind of get into it, or some people maybe buy a little bit here and there and then kind of get into it. But I think, as we're getting farther into all these scandals and some of these things that are popping up in the news, and a lot of this negative, I guess, FUD surrounding Bitcoin and the crypto markets, as unfortunately a lot of people kind of group those together. I think people are going to be a little bit more tentative, and they're going to have to start to try to understand Bitcoin first. So I think there's going to be a little bit of a shift towards education and shift towards, what people are really investing in, I guess, in the next couple of years or so, especially with, a potential recession and the economic state that we're in, where people are going to be, maybe keeping their dollars a little bit closer to the vest, opposed to just throwing it at necessarily anything.
Just to reset the room, everybody here, please make sure you follow Brandon, who again runs a number of spaces himself and is always a great and kind host in the times that he's had me on. Again, my name is Michael Gayed. This will be available as podcast under Lead Lag Live. Let's do a little macro talk.
Yeah, I mean, I can go ahead and answer this, and then Michael can, I guess, follow up and see if he agrees or disagrees. But the way I view the real estate market, I've had, a couple of great real estate guys come on my spaces, so this is kind of, I guess, educated from them. But yeah, I see a lot of different markets, obviously, reacting a little bit differently. So I think a lot of the states where people kind of fled to during COVID, I'm thinking like the Floridas, the Texas, the Tennessees, maybe some of the bigger cities like Miami, Tampa, Nashville, Austin, what have you. I think that they're gonna kind of come down a little bit because they probably saw the biggest run up in a lot of them, but they're probably going to stabilize here, relatively quickly, because jobs and everything like that, it became more desirable. So people are flocking to some of these cities, kind of realizing like, hey, why live in some place where it snows heavily or is cold all year round, where I can live in sunny beaches in Miami 24/7, 365. So I think markets like that are going to, kind of still hold true. Rental markets are still kind of increasing in those areas, but housing is kind of stabilizing. Where I think like some of the bigger markets where we've seen a lot of people kind of flying out, I'm thinking California, maybe cities like Boston, Philly, some of those other cities like that. I think those ones are going to really start to hurt. And those ones didn't really quite see the COVID run up and that kind of stabilization that'll occur in some of these other markets. I think those ones, as interest rates kind of keep increasing and money kind of keeps getting harder and harder to get to, people aren't really flocking to these cities. You're going to see a lot of these home prices in those areas kind of fly down. And I think, rental markets and other things like that too are either going to stabilize or maybe even go down in some of those markets where they're kind of going up in, the Floridas, the Texases, and they're just kind of getting outrageous in some of these places. So yeah, that's my thought on it. I don't know if Michael's got anything to add on there.
Yeah, so first of all, I think you're going to have a real bifurcation because any kind of housing transactions that probably happen on a go forward basis are largely going to be all cash transactions, because who the hell is going to want to pay and lock in a 7% mortgage rate? I mean, sure, you can do it on the bet that you can always refinance lower, but I find it hard to believe that that's going to be a dynamic that most people will be comfortable with. And that also brings with it a whole nother complication. Somebody had once tweeted to me, I think it was actually a couple of days ago, said something like, I'm not worried about mortgage rates at 7%, because I have my existing mortgage at 2%. Why would I even bother putting my home up for market if I know I'm going to be paying so much more for another home? So I've made this case before. I think I even had on the pinned tweet for a bit. I think we're going to have this strange, odd equilibrium that looks really weird, in the sense that you have demand collapsing, but at the same time inventory collapsing even further. That's going to complicate how long the bear market in housing lasts and how the path, I think, plays out. And that also is why I keep going back to, I think the broader bear market in the stock market will take a much longer time than people realize, because I don't think the stock market bottoms until housing's done with its own decline. But again, the sequence and the path, I think, is going to be very tricky to really get a handle on. And the truth is, honestly, if you really want to, I would think, and Brandon, maybe you can add some thoughts to this. If you really want to identify where housing bottoms, you probably have to watch the secondary and third, homes, right, that are being used for those that are renting for the Airbnb type of host, right? That you got to get rid of the secondary home market and make it more about the primary residence. And given how much property has been bought up purely for income generating purposes and not for where you actually live, that too would take a while to really break. But Brandon, go ahead.
Yeah, I mean, I agree with that as well. I think a lot of people had, like we've kind of alluded to earlier, easy access to capital. We had a lot of, run up in, valuations of houses. So if you bought a house 2019 or even, early 2020 or what have you, that evaluation in some places might have even doubled. And then, I think a lot of people from there borrowed against that money and bought other, trying to make some income generating houses, Airbnbs, short-term rentals, so that kind of thing. And those houses have kind of blown up. I mean, anecdotally, I have an Airbnb in Tampa, Florida, and it's been doing well, but it's more for, I guess, like longer term stays. And from what I know from other groups and what have you, the ones that are on the beach and in those kind of vacation-y areas, they haven't been doing quite as well, just because, one, people haven't been taking as many vacations like towards the end of the year, as, inflation is kind of rising up, expenses are rising up, people are kind of not spending quite as much. And two, the variability with Airbnb as kind of turn some people off of that, and they'd rather stay at some hotel or something like that opposed to Airbnbs. So I think it's going to be something interesting to watch. It's definitely one company that I'm going to be looking at their financials and other things like that in their quarterly reports, just to kind of get an eye on housing and how many users or hosts are coming online and other things like that too. So I think, as far as like Airbnb goes in the next year, it might not be the most profitable thing, but people are going to be getting rid of some of those maybe second homes or income generating properties, just because they can't handle all the expenses.
Yeah, no, I'll just add real quick. I mean, keep in mind, I keep going back to this point. The Fed pivots historically are bearish. It doesn't have to be, right? But usually the bulk of the drawdown in stocks and in the economy is because the Fed does what it always does, which is, act late, which means they're responding to things already weakening and the momentum's already there on the downside. I go back to, so I did an interview with, I'm forgetting his first name, of Pulte. And yeah, he was making this point that, home builders don't really have an incentive with high rates to build. You have got so much local red tape that it's almost impossible to build quickly and efficiently, even if you can. And unless you really get, sort of the local governments, the municipalities creating targeted incentives to build inventory, the reality is we have a really, really tough position as a country in terms of the number of homes that are just available. And never mind, again, the institutionalization, that comes in as these mega companies swoop up different properties. So I'm with you. I think the point is, I think this is just going to be a lot more of a complicated cycle than what we're used to. And even in my world, right, it's like I want to see rates fall during high volatility, but I myself do believe that the average rate is still going to be probably pretty elevated. You'll have these wiggles, like even like today, where treasuries are slightly positive on the day while equities are down hard. That's consistent with real risk off, but that's probably going to be more what we're in for going forward, as opposed to these kind of real collapses in yields, which hopefully would at some point then benefit housing. I just don't see that happening the same way.
Yeah, I was just gonna say, yeah, I agree with you, and I agree with your point too there, that I think that the pivot's going to be coming later than a lot of people are kind of expecting next year. I think that that's not going to be maybe until late 2023 or maybe even 2024. So I would kind of expect housing to be somewhat of a lagging indicator that kind of floats around for some time.
The other thing I would say about that is the Fed hiking rates does not mean necessarily that mortgage rates would go up, unless it's a function of consumer default risk premiums increasing. And I say that purposely because I keep going back to this thing I keep hearing that I keep proving is not factually true. The Fed does not control the long end. There are plenty of times where the Fed hikes rates and the long end ends up dropping. Now, mortgage rates can rise on a relative basis because you've got to factor in, a weakening consumer and sort of default risk from that perspective. But either way, housing would be cooked no matter what, because even if the 30-year mortgage rate were to drop, right? The reality is, as long as the short end is dramatically higher than the long end, no bank has an incentive to lend. So even though the mortgage rates might be cheaper, you're not necessarily going to get access to it, right? So, and I made this point before. It's like I said so many times all year. It's like the Fed should just do an emergency 300 basis point hike. Just destroy the system to save the system, so to speak. If we keep on going through this purgatory of the Fed constantly trying to play catch up, which, by the way, they probably are still having to do. I mean, one of the things that's been perplexing, and Brandon, you can talk about this too, I'm sure. You haven't had credit spreads widen. Everyone says the Fed's going to raise rates until the stock market breaks. It's not about the stock market. It's not. It's about credit spreads. It's about default risk premiums. That really has stayed unbelievably tight. Another one of those really bizarre dynamics that threw off the whole risk on, risk off dynamic this year, right? So the fact that even internally in the bond market, there isn't concern about the higher cost of capital is giving them the leeway to keep on raising rates.
Yeah, no, I mean, I think that the Fed's goal here is to just kind of help out the United States at the end of the day. So I think raising the interest rates is just kind of killing the offshore dollar market. I know Phil and I have kind of worked on a lot of spaces about that, but I think that at the end of the day, that's kind of their goal. And Michael, I agree with you. I think they should have just shocked the system at some point. But anybody can kind of play Monday morning quarterback at this time, I guess. But I think looking back at it, that the Fed just started raising rates too late, and I think just going forward, they're just going to have to kind of continue just playing catch up. And yeah, I mean, I don't really foresee it slowing down anytime soon. I know a lot of people are just kind of crying for it because of the stock market, but yeah, like you said, that the Federal Reserve doesn't necessarily care too much about the stock market.
And I'm sure, Brandon, you have the same challenge. It's like it's so easy to do nothing but talk about the Fed on these spaces, and I try my best to not be about the Fed, but it's like you have to break it up at some point, right? So it's just one of the most maddening things is that we've gotten away from true analysis, and it's more about just what the hell Powell is saying at any moment in time. Just drives me utterly insane. But before Brandon, you chime in, because again, you're the guest for the hours. I want to focus on you. I will say, I got a lot of flack from people when I said this year is worse than 2008 and worse than 2020, and I said that back in like March, April. I continuously tweeted that, right? But your point about mark to market, I really do believe is a really important one. One of the arguments for why it's believed that we had such a volatile period in 2008 was because assets were being marked to market, illiquid assets were being marked to market. And the moment you have visibility on something that is illiquid, it creates problems. It creates optics that cause investors to en masse sell and panic. If you were to mark to market mortgage securities, all the shit that has gone through this horrible drawdown that is the supposed safe collateral, this would be worse than 08 and worse than 2020. So you're hitting on something which is really, really important. We don't know it or feel it or see it because it's not priced real time. If it were, everyone would be losing their fucking minds. It's funny. I had on I tweeted it out when I saw it. One of the YouTube comments to one of these podcasts I had done when I made that point, worse than 08, worse than 2020. Person said, "Oh, what are you talking about? You haven't had a single company go under." And my response to the YouTube comment was, "You almost had the entire fucking UK go under. Like, are you kidding me? Like, you almost had an entire country, literally an entire country, go under, and people are acting like this is normal, right? And let's just look at charts on the Dow Jones Industrial Average, and let's just draw lines. It's like, give me a break, guys. Like, there's something much more serious going on."
No, I mean, yeah, I think I'm not really surprised at hearing that, unfortunately, and I think that that's going to kind of continue as we go along here. But yeah, I don't have too much of an opinion, I guess, on that.
Yeah, I mean, that was always the most mind-numbing thing: the Fed buying up, MBS, all these securities when housing was already strong. Just asinine behavior. Just so I think there is this dynamic, and I'm trying to flesh this out even myself, but I think this is why this is so bizarre. So the Fed, if the Fed were to keep on hiking rates against all the government debt that's out there, the omnibus spending, all the reckless money printing that's still going on from the money transaction from the fiscal side, if the Fed were to go to that level, then interest expense on federal debt is going to swell your tax base, which means that the interest rate then isn't what the Fed sets; it's probably double that, because then the bond market starts pricing in default risk by the U.S. government. So you have this really weird dynamic, right, where they got to raise rates, but if they raise rates too much, it makes it impossible for the government to deal with its interest expense, which means now rates then skyrocket because they can't pay off with their tax base. Right, right. So it's like I don't, and I know that sounds like a strange argument, but it's like if the Fed's going to try to hike rates to above inflation at 7.5, 8%, the real interest rate is probably 15% at that point.
Yeah, I mean, I appreciate the anecdotal stuff about Bitcoin in the book too. I'd also recommend the Bitcoin Standard by Saifedean Ammous. He's an economist, and that he breaks it down really well, just kind of like the need for Bitcoin. And then he also has a follow up book called the Fiat Standard that kind of goes into some of the issues in the current fiat system and what has kind of ended up, I guess, suffering because of the fiat system as well. So I think those are two great books to educate yourself. And yeah, I appreciate your insight. Thanks for coming up. And that on the housing and everything else too. I do agree that people are going to kind of maybe move away a little bit from Airbnb and move to maybe some more of the traditional, I guess, housing and vacation, I guess, rentals, whether it's like hotels or other things like that. Some more pain to be felt in the market. And, I think it's interesting that you brought up Bitcoin, because whether Bitcoiners want to admit it or not, it seems like it's still pretty fairly correlated with a lot of these, growth and tech stocks and everything like that right now. And it's just, a little bit more volatile. I do think that there's going to be some more pain, as I think we've been kind of talking about it. Seems like the market's screaming for the Fed to kind of stop raising interest rates and pivot. But everything that the Fed is saying seems like they're going to keep on raising rates until the end of the year. So if that's kind of the case, and the Fed keeps indicating that and doesn't indicate a pivot, I imagine the market's probably going to react and be bearish going forward. And I kind of think that that's my outlook for 2023 is definitely not something that's super positive, unfortunately. But I think now is the time to kind of really understand what you're investing in, and take a dive into whether it's the companies or other things like that too, because understanding some of the fundamentals behind some of these companies, and whether it's Bitcoin or something else, will kind of help you ride some of these waves, as I think the next couple years or so are going to be pretty interesting and maybe a little bumpy as well.
Yeah, and for whatever it's worth, I believe it or not, I really don't look at charts that often. I mean, there's specific relationships that I focus on. That's why I always say it's about conditions, not predictions, right? And look, when you're in an environment where liquidity is waning, when you're in an environment where credit contraction is taking place, it's not about the chart; it's about the tail. In other words, it's about the extreme that can happen, because a lot of big declines have that characteristic of an illiquid type of precursor, right? So that's why I focus on lumber relative to gold, because it's about housing, which is about credit creation, credit contraction. That's why I focus on utilities against the market, because utilities benefit when rates are falling, which means demand for money is falling, which means liquidity is falling, right? So could unequivocally be the case. And I can be a technician like a lot of people that you see on FinTwit. I don't believe in levels, but when I see the conditions like this, I go back to that line I've said many times before: markets tend to crash from oversold levels. They also can have rip your face off rallies, right? But you end up having these environments where it resolves itself in an extreme. Where it happens or what the extreme is directionally, nobody knows. But the conditions, I would argue, at least for now, still suggest that there's more of a tail risk element that's out there when it comes to Bitcoin, the broader stock market. And until that dynamic changes, it's not about support and resistance. It's just about avoiding panic if it's coming. If that makes sense.
Yeah, I mean, I couldn't agree with you more. And I think, everybody that was, maybe affected by COVID in 2020, whether it's lost their job or something along those lines, I think they all realized kind of how fragile and how, much everybody, like, people in power your boss, like your company, all that kind of holds you almost like hostage if you have that only singular source of income. So I think, from there, everybody was kind of scrambling, finding ways to try to, like I kind of alluded to a little bit earlier, like increase their wealth, make generational wealth. That kind of was the buzzword going around, and people were starting to learn about some of that stuff. But what was really making the headlines was a lot of these Dogecoin or GME or AMC just kind of exploding through the roof. And I think, for the average person, they just see that and they try to FOMO it in and, be like, hey, I want to be like X, Y, and Z, or they're scrambling, or maybe they even just got like a stimulus check and they just threw their, $1,500 at it, or whatever it was. So I think that, just the overall risk kind of COVID woke some people up and had them take a little bit more risk. And, I think people were just kind of ignorant. They were thinking about these get rich quick schemes. And I think, they've been around for a long time, but they've never really been as public as they have been right now. And that's just strictly, because of mediums like this, the spread of information and other things like that too. So I think because of that, it made things like GME and some of these, shit coins just kind of rise in popularity. And as they rose in popularity with really no backing, that's where people were able to kind of borrow against it and, have big marketing dollars and kind of put it in your face a little bit more, which kind of caused this snowball effect. And I think we kind of have an issue right now, especially with the rising inflation, is a lot of people that are kind of getting into the job market, or maybe the younger generation, maybe millennials or Gen Z and what have you. I think, they're having to run into issues where, they go to school, they say, go to, I don't know, engineering or do some, get your master's degree. They graduate with all this debt and then they can't afford an apartment without a couple roommates and other things like that. So they're trying to, on the side of their 9 to 5 job that they're working, learn how to become investors. And some of them are just, hey, I'm too tired to learn this. Like my friend told me this is going to go boom. So they're just kind of jumping into it. So I think it's not only some ignorance, but it's out of like the need, I guess, of to try to increase your overall wealth, which is unfortunate, just kind of the overall state of the economy. But I think that plays a big part in it, and it was just kind of a snowball effect that caused a lot of pain, unfortunately.
Yeah, I would agree with that 100%. I've been quoted myself as saying, the Fed brought out the worst in humanity, and the Fed destroyed old stores of value because they forced everybody to take risks because you couldn't make money from sitting in cash in a bank, right? I mean, it is. I go back to conditions, right? The conditions were set by the central bankers. It's unfortunate that unfortunately those conditions result in a lot of pain for those that, whether they rightly or wrongly took risk, felt they had to. And I think from that perspective, it's an unfortunate set of circumstances. Anyway, with that said, everybody, please make sure you follow Green Candle here on Twitter. Brandon, of course, check out his spaces. This will be available as a podcast soon enough. So everybody, do appreciate the constant support and enjoy the rest of your evenings wherever you are. Thank you, everybody. Thank you, Brandon.